You might already be aware of this. A majority of active large cap funds have underperformed the benchmark for the last many years. The number of underperformers has ranged from 31% to 88%. In 3 of the last 5 years, this number was above 50%, meaning that more than half of the active funds underperformed the BSE 100. But there is at least one fund that has remained an outlier. Hello and welcome to ET Money's YouTube channel. But before we tell you about this fund, a quick update. You are watching this video on ET Money's English YouTube channel. We also have a Hindi channel where you can get all our videos in Hindi. And if you are someone or know someone who wants to understand the basics of managing and growing money in an interesting way, we have a channel 5-Minute Finance where we cover everything in under 5 minutes. Now let's begin. Today we are going to talk about a large cap fund that is yet to be affected by the onslaught of passive funds. The fund's name is Canara Robeco Bluechip Equity Fund. We will try to decode the reason for the outperformance by this fund. More importantly, we will try to assess if this outperformance can continue. Now this video is divided into 3 sections. Number 1, performance of Canara Robeco Bluechip Equity Fund. Number 2, how is this fund managed, or what is the reason for the outperformance by this fund? And number 3, what are the points that you should keep in mind if you are invested in this fund or are looking to invest in this? So let's begin with some performance numbers of this fund. Let's begin with the fund's trailing returns. Since the fund's been managed by its current fund manager since July 2016, we will assess up to 7 years of returns. Over 5 and 7 year time spans, the fund is ahead of its category and benchmark by a respectable margin. If you had invested 1 lakh in this fund 5 years ago, you would have over 2 lakh as against the 1.8 lakh in the case of large cap category and 1.85 lakh in the case of BSE 100. SIP returns present a similar picture. If you had invested 10,000 monthly in this fund for the last 5 years, your investment of 6 lakh rupees would have turned into about 9.75 lakhs. The same investment in the category and the benchmark would have become 9.32 lakhs and 9.52 lakh respectively. Now, in terms of calendar returns as well, the fund has done well. Out of the last 7 calendar years, the fund has outperformed both the category and the benchmark in 4. In 2, it outperformed the category but not the benchmark. Lastly, if we check the fund's average 5-year rolling returns, the fund is ahead here too. Rolling returns help assess the consistency of performance. 5-year rolling returns are returns across any 5 years between August 2016 and July 2023. These numbers were then averaged to arrive at the data on your screen. Rolling returns clearly show that the fund does considerably better across 5-year periods than the category and the benchmark. It has managed to deliver 2-3 percentage points more as compared to the category and the benchmark on average basis. So be it trailing SIP return, calendar returns or rolling returns, this fund has done well. But what is the reason for this? How is this fund managed? Well, we will get to that. But worrying about performance is unavoidable when investing in active funds. However, one thing you won't have to worry about for life from now on is healthcare expenses. That's because you can now get a 1 crore health insurance starting at just 987 per month on the ET Money app. It is big enough to cover all medical expenses for life. The plan comes with a host of other benefits as well, including extensive coverage, no premium increase till you make a claim, and much more. Now let's understand the reasons for this fund's outperformance. To figure out why this fund has done well, we had to look at a number of data points, and after looking at them, we prepared the key reasons. Let's see them one by one. Number 1, the fund has a low expense ratio. Don't be surprised to find the mention of the expense ratio right at the start. In large cap space, the expense ratio plays a major role in a fund's underperformance or outperformance. That's because the universe of large caps is rather limited. It is just 100 largest stock by market capitalization. Since active large cap funds must invest at least 80% of their corpus in such stocks, they have limited room to outperform the indices via stock selection. That's the reason for the underperformance of many active large cap funds. Now in such a scenario, a low expense ratio can help boost a fund's returns. The fund has maintained a low expense ratio, and this has helped the fund outperform its benchmark and its peers. As of July 2023, it has the lowest expense ratio of just 0.43% in the category. Number 2, the fund likes to ride its bets and doesn't churn the portfolio much. If you look at the fund's portfolio turnover, it is quite low compared to the category. Now, if you're not sure what portfolio turnover is, let me explain. Portfolio turnover is how much of a fund's portfolio changes over time. In the chart, you see the yearly portfolio turnover. So at July end 2023, if the fund's portfolio turnover was 20%, it means the fund's portfolio changed 20% over the last year. On the other hand, at the category level, the portfolios changed by 61%. This shows that the fund doesn't like to buy and sell frequently. Instead, it stays in its stocks picks and hence has higher conviction in them. This conviction seems to have worked in the fund's favor. Now, the fund's portfolio turnover has remained well below the category average in 4 of the last 5 years. This is a remarkable trend. Now, if you see the percentage of AUM invested in the stocks overlapping with the stocks in the fund's 2018 portfolio, this number has ranged from 60% to 72%. This is again a testament to the fund's buy and hold approach and conviction. Number 3, the fund has shown remarkable consistency in its top bets. The top bets of any fund are crucial as they tend to drive the fund's overall performance. The top bets are even more crucial in case of large cap funds. Why? Take a look at the table. Be it the fund, the category or the benchmark, the top 10 stocks constitute about half of the allocation. So the top 10 bets have a crucial role to play in the performance. Canara Robeco has maintained remarkable consistency in its top bets. So it is very likely that the performance of the top bets has contributed significantly to the fund's outperformance. This shows superior stock picking skills by the fund manager. In his media interviews as well, the fund manager has stressed that he likes to focus on the quality of business, management and balance sheet. He doesn't like to pay much attention to the day-to-day movements in the market. Instead, he likes to focus on the underlying business. Number 4, the fund contains downsides pretty well. Now, another attribute that has likely contributed to the fund's outperformance is its better downside protection versus the category and the benchmark. If we look at the quarter since August 2016, when the BSE 100 has given negative returns, the fund has beaten the benchmark and the category in all but one quarter. Simply put, because it falls less, it is able to retain its returns, which helps the fund outperform in the long run. So these were some of the likely reasons for the fund's performance. Alright, now if you're someone who has invested in this fund or are looking to invest in it, what should you keep in mind? Let's find out. The first point is the near-term returns of the fund versus its category and benchmark. If you look at the 3-year returns, signs of fatigue in performance are visible. The fund is behind both the category and the benchmark. While the difference between the fund and the category returns is marginal, with respect to the benchmark, it is more than 1 percentage point. A similar trend is visible in SIP returns. The fund is behind the category by about half a percentage point and behind the benchmark by almost a full percentage point. While only time can tell if this trend continues, keeping an eye on the fund's performance would be worthwhile. Large cap funds are mandated to invest at least 80% of their assets in large companies, but they do have a freedom to invest up to 20% in mid and small caps. The chart shows that the fund doesn't seem to use this leeway. The fund had no allocation to small caps from 2019 to 2023. It did invest a small percentage in mid caps, but even that number has fallen from 11% in 2021 to about 4% now. Now, as we know, mid and small caps have done very well over the last year or two, but maintaining distance from this segment has likely resulted in underperformance by the fund. It is also probable that the fund has steered away of this segment due to the overvaluation post the recent run-up. Whatever the reason, it is good that the fund is true to label. But in large cap segment where outperformance through stock selection is getting difficult, the fund manager needs to look at other ways to deliver. So this is what we had for you about this fund. If you have invested in this fund or planning to invest in it, you can use the information in this video. But don't forget to do your own research. And if you found this video useful, do share it with your friends and family, and don't forget to subscribe to our channel. And I'll see you with a new video very soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.